Welcome back. As promised, let's invite Anirudh Garg on the show now. He's from Invasset PMS. Anirudh, thank you very much for joining in. We just saw the mutual fund data for the month of March, and despite the rebound, the inflows into equities have fallen by 14-15% compared to February, which was anyway a very tough month. What are you all doing at Invasset PMS? Have you all also retreated from investing in the market? And do you think this rebound that we're seeing today is sustainable? What's the advice now, and what are you doing with your portfolio?
Good morning, and thank you for having me. I think we at Invasset PMS focus a lot on the behavioral finance part of the market. And we feel that, as I mentioned last time on your program as well, that we are now very bullish on the markets. The only fear that we have right now is that if it is only about tariffs, then it's okay. Things will be all right. I think the market may have even bottomed out. But sometimes what happens is that a systemic risk sometimes gets, gift wrapped in some other situation, and the things are avoided. And America, if we see, has been at the forefront of it every time. So we are not predicting any bear market from here, but we are being cautious also, though fully invested.
Understood that. Anirudh, I believe this indicates a very marked change as far as your own stance is concerned. Last time we spoke to you, you were sitting on very high levels of cash. So what actually has triggered the change? Is it mainly on the back of the fact that the market correction has made valuations very palatable?
Yeah, absolutely. So there are 2 points. When we sold off, we were one of the only funds in India who went to 100% cash. The reason that time was that the valuations were expensive, and there was too much greed in the market. The exuberancy could be clearly seen if you wanted it to see it. And now, on the other hand, the valuations are better. You're getting your portfolios 35-40% below. Even the mid-cap index is around 25-26% lower. So the valuations are right. And as you mentioned, since the mutual funds SIPs have stopped and the numbers are going down, this clearly indicates that there is fear in the market, or there is uncertainty. And if we see majority of the bull runs, be it COVID, post-COVID, or post-Russia-Ukraine war, majority of the bull runs, they stem from a period of chaos. So we are very, very optimistic on the market. But on the same side, we are maintaining a cautious stand as well, that if something bigger turns out to be, we are ready for that.
What about technology? Technology has been the rank underperformer. And now some stocks like Infy, TCS are trading below their long-term average multiples. That said, yeah, so where do you stand on tech, especially the large cap names?
Yeah, so you're absolutely right here. Tech in the last 1.5 months has taken a beating, which has brought down the valuations at very, very mouth-watering levels. But we do not hold anything in tech now. We buy value only when we believe that, firstly, there is overall value in the market. So this is the right time to buy value. But we should see, consistency or visibility of earnings for the next 2 to 3 years. And primarily, we want the rates to be higher, the rate of growth to be higher. That is why we are not, holding a large position. Barring a couple of stocks in the mid-cap tech, we are not holding any positions in tech, because that is the lack of growth is the only reason we feel that we do not venture into the ground. But if you look at value, I think large cap IT is surely, as you rightly said, there is value in the large cap IT now.
Anirudh, we want your views on 2 specific sectors. The first one has to be the pharma pack has sold off significantly. There are still worries of impending tariffs, but are valuations now impending? And would you take a view on whether or not tariffs, especially for Indian generic makers, will be applicable? And secondly, one space that's doing very well is chemicals. Again, a sector that saw significant sell-off in recent times. So would you like that space as well?
I think I like both these spaces. I like pharma. Pharma is our top bet. So we would say around 20 to 25% of a portfolio is now pharmaceuticals, because we see that growth factor there. Though we focus more on the CDMO and CMO part of the market, where we feel that growth and relative change will both be very strong for the next couple of years. The point here right now is that we have to ignore these noises of what the tariffs will be. How Donald Trump will react, I think nobody in the world knows about it. What is his purpose? What is he doing? What are the strategy? rather than focusing on all these noise, we should focus on where the fundamentals of the companies are and where relative change can be strong. So pharma, I think, is very, very nice. And you rightly mentioned chemicals as well. We are seeing strong tailwinds for chemical sector as well. And I think for the next couple of years, it should be a medium to good sector to invest in, chemicals. But pharma, we are very bullish.
In chemicals, could you give us some more color on what you like? What should investors look at?
So we are not holding very significant positions in chemicals because they're not reached our top 25 to invest in because we are finding better opportunities. But yes, I think if somebody is holding positions in the chemical sector, and I think all of them, primarily, this is a time where you have to be with the leaders. So if you know your company is a leader in a particular type or particular segment of chemicals, then I think it is right to hold on to them. I think the last 2 years, which were not very, very great for chemicals, the next couple of years should be better.
Anirudh, one clear avoid you mentioned is, or one clear cautious stance is the IT pack. FMCG, are you cautious there? Would you turn buyers at current levels?
No, so again, FMCG for us, we go to FMCG only when we need to be in a defensive space, okay? But okay, again, the relative change for FMCG is very strong, 1.2 lakh crores coming in the hands of the Indian consumer, and then, inflation getting better, the prices softening. And overall, I believe that FMCG, as it has underperformed, again, like chemicals, as it has underperformed the last couple of years, should not underperform for here. But again, we're not holding a lot of positions in FMCG. On the other hand, we are focusing on newer market segments where growth rates can be higher in the consumption sector as well. Consumption is a number 3 bet, but again, some better companies here rather than the old traditional FMCGs.
Okay, and any view on quick commerce? Any view on as far as the new age tech companies are concerned?
I think new age tech companies should be all right. Especially delivery platforms and all these new age companies still have a room to grow. They still, I believe the valuations are not that high, especially after this fall, the valuations have corrected, and I think they are okay to invest in. We like the new age companies now.
Thank you so much, Anirudh, for joining us, giving us your view on a whole host of markets and a marked change as far as your own stance is concerned from being quite cash heavy to aggressively deploying across the market is something that we've noticed. Well, it's now time for a short break. We'll get you more on the markets on the other side.